Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin McGrath from Financial Edge Group. Today, we're fortunate enough to be sitting down with one of the experts in the industry. We work very closely with Lonsec, and we're fortunate to have Lucas to help kind of answer some questions about what's happening in the market at the moment. And so let's dive into some questions with Lucas. You talked about, I suppose, opportunity taking risk in some of those other assets to perform more like equities, and at that point you might as well be in equities, and that has come up, I suppose, in some conversations recently with clients. That might be that they've seen an article in a magazine or a newspaper, an advert about a mortgage, and without naming names, but different mortgage funds or unlisted things, all of a sudden are guaranteeing a 4% kind of interest rate return. Obviously, there's risk involved with those kind of investments. Do you want to talk about that for a second?
Absolutely. So, unlike equities within fixed income bond markets, if you sort of think about it, the most simplest way to look at it is any return above what cash is paying is risk within fixed income markets. You're being paid that extra for taking on more risk. The important thing to note that is, though, if for whatever reason, and you get a default of the asset within fixed income, well, that's basically you've basically lost. So it's a sort of asymmetric return profile for fixed income. So what we would sort of say is that just be aware that if you are getting the bigger return, whatever the assets are, they are taking on more risk. Risk is not a bad thing, but I think the important thing is to just note it's not cash.
Yeah.
So it's not your money's not locked up in a sort of cash asset. It is taking on more risk. And if you do, if the markets were, if you had, for example, what we experienced in last year with fixed income markets, where a lot of them locked up, and you did see quite negative returns. So it's a question of where do you want to take risk, and also just noting that if you are getting in fixed income markets any return in excess of cash, that's because you're taking on more risk. Basically, that's it.
Yeah, I think it's a good time. I think that's similar conversation we have, that if you're getting in the moment a 4 or 5% return, but everyone's only paying 3% on their home loan, if you're getting 5%, someone else is paying a much higher rate. They're paying at 8s and 10s, and they might be able to pay that for a while. But as you said, if there's a default on that asset, there's a reason that person's paying 10, and there's a margin being taken. You're getting 5. That the risk for that on the other side, the person borrowing that money is much higher, and that might be fine for certain months, but that default risk that might exist in a certain market in the future might significantly impact that bit of extra interest you're getting now.
Yeah, absolutely.